Basant Maheshwari, author and investor. Basant, great to have you back and thank you for joining us.
Thank you.
I'm going to take the clock back. We interacted on the same forum exactly 6 months ago.
Yeah.
And 6 months ago, you were of the view that one should buy into Page Industries. So my compliments. I doubted your conviction, but the stock has gone from 8,000 to 14,000. Right. And is the stock looking still good?
Stock is looking good, price isn't, but just, it's the problem is in this current environment, if you see, there aren't too many companies growing. So there's a big scarcity aspect. So any company which can come and tell you that we're going to grow at 25, 30, the market doesn't give it a second chance. It says, okay, let me lap it up. Now, at this moment, you have to understand, if the entire economy grows at 8.5%, and if L&T grows at 25%, and GVK grows, and GMR grows, and everybody keeps growing, then the exclusive element of these few handful of companies which are growing at 30, 35, 25, whatever, will slowly dilute itself. But what if the economy grows at 8% and the company which was growing at 30% starts growing at 40%?
Can it happen?
I mean, it's discretionary expenditure, not specific to Page, but I think if you can grow at 30% when the GDP is growing at 5.5%, if the GDP grows at 8%, you can obviously grow at 40%. So what would happen in that case is the valuations won't compress. The earnings would wait. I mean, the price would wait for earnings to catch up. It's like this. The most eligible bachelor doesn't get the most beautiful wife. He also gets a lot of dowry with her. So, it's like that. And you can fight with your wife, but you can't fight the ticker. The tape is there. See, lever, how much is it growing at? 10, 12%? Look at the market cap, 2 lakh crores or whatever. So 40 PE, growing at 12%, one stock, other stock, 30% growth, and 60 PE, 50 PE. Now the 60, 50 is also debatable. Whether you're going 15, you're going FY16, you're going FY17, that is also debatable. But obviously, I mean, it's not a cherry pick right now, but brands which can grow is like a Christmas cake with icing on the top. So that's it basically.
The problem with the Christmas cake is that it can get stale also.
Yeah, it does. It would. It would. That's human nature. I mean, it will. But you should make so much before it gets stale. You should have your fill and you should be ready with it. So that's it. That's a part of life. You cannot.
You are in no hurry to reduce your exposure to Page Industries?
No. I will tell you, the long trends of a stock, normally 3 years, 4 years, 5 years, 6 years, if it's a free cash flow company with free cash flow, then the stock price doesn't collapse. If the cash flow is negative, then the stock price collapses and comes down to meet earnings. But if the cash flow is positive, the market gives it 1 chance, 2 chances, 3 chances. So the trick with these companies is, the high PE companies is, as long as they're cash flow positive, one should not be in a hurry to sell them. But if they're cash flow negative and they are diluting capital, they're raising capital and they're going into debt and things like that, then there's a problem. Then you have to be very sure of what you're buying.
But if you buy stocks which are trading at P multiples of 40 plus, 50 plus, 60 plus, can you make absolute returns?
We have been making returns. It's not that we have not been making returns. But is Cummins overvalued or undervalued?
That's a judgment call.
That's it. Cummins is also at a very high PE. But it says we'll grow at 5% here. See, the problem is you have to look at PE not in relation to the growth of the current year, but in terms of how much predictable it is. So I'll tell you, if you give me 2 options, one company growing at 40% for the next 2 years, after that I don't know, trading at a PE of 20, and one company which tells me I'm going to grow at 20% for the next 20 years, trading at a PE of 30, I'd rather buy the 20% grower company for the next 20 years at a 30 PE than a 40% growth company where I don't have a vision of what's going to happen after 2 years.
So you're clear on Page for next 2 or 3 years? You're happy to own it for next 2 or 3 years?
I'm happy to own it.
But you're not happy to buy it?
No, it's not that. I mean, it's all a function of things. I mean, see, cotton prices have collapsed.
Okay.
China, which was a big importer of cotton, they've now started getting it on their own. So things like that. But it's not a recommendation, obviously, over here. But now next year or 2 should be good for them. But I don't think that this rate of growth will continue for the next 10 years. What's happened has happened. But the momentum will just move on and let's see what happens. So it's very difficult to say as to when I would actually exit, because even I don't know when you would exit. You exit based on, see, the past is always based on facts and the future is based on feel.
Of investing is getting challenged, which according to you is not getting challenged. So the business is in good group. Okay, let's move on and talk about housing finance companies. And great call. These stocks have just gone from strength to strength. So first, let's talk about the housing sector per se. Do you think the housing sector is on a cusp of economic recovery? because interest rates are coming down, affordability will move up, and there is a renewed thrust on smart cities and affordable housing.
Yeah, that is there. And plus, if you just have a look around, these companies, again, the same thing. They've been growing at 25-30% when the GDP was growing at 5-5.5. So if everything happens, the growth should also go up. But more importantly, again, the same argument which I gave you some time back. I mean, look at the entire scale of opportunity. They can grow at 20% for the next 10-20 years also. But since the stocks have gone up so much, last 3 months, they've been kind of sideways. So which is like saying, okay, they've gone up so well, so much, let them be sideways. But the long-term thesis doesn't get challenged over here at all.
I mean, only fear there is that the entire home finance space is getting very, very competitive. Everybody wants to have a piece of that
HDFC Limited, ex-HDFC Limited, they don't even total up 50,000 crores of market cap. Grow is 10,000, Repco
banks
is 3,000.
Also have their own subsidiaries.
No, but banks, once industry starts to recover, you think banks are going to lend at 10.25 or go and give working capital loans at 16%? There's no incentive for a bank to fund, and it's granular. 10 lakhs here, 20 lakhs here, 30 lakhs here, 40 lakhs here. Banks would want one guy to come and take 200 crores because the balance sheet size is so huge and large. So I think the entire thing, look, sometimes dismissing a stock by saying it's at a high PE isn't the correct thing to do because the entire market cap of the sector is so small in comparison to the scale of opportunity that the high PE will remain there. And as long as the predictability is there, I think they will sustain. So that's it. And they are all wholesale borrowers. And wholesale rates have started to come down. So that effect will also come over the next year or two.
What amazes me is the disconnect within the entire housing finance space. Everyone is absolutely clear on the size of the opportunity. The runway is absolutely clear. But if I look at a Divan Housing Finance, the price to book is about 2 times. Graho Finance, price to book north of 15 now. They all are catering to the same club. Yet the divergence is so large.
See, if Graha does a QIB and doesn't give dividends, it will also come down to a price to book of 4 times. Problem with Graha is, it doesn't do a QIB, it doesn't dilute. So obviously, if you dilute at 10 times book, your book value will also go up, and it gives you a dividend. So you cannot fault a management by saying, see, you're not diluting capital and you are giving us dividends. So obviously, your valuation is high. Basically, valuation is not a price to book isn't just one thing. You have to look at price to book
return on
in
equity.
relation. Right, exactly. So return on equity. So Graha is generating a return of equity 35%. If my memory is correct, I don't think there's any company in India in the banking financial services space which has ever generated an ROE of 35%. I don't remember any company. Maximum. So
Graha is corrected from 350. I could be off by 10-15 rupees. From 350 to about 250. That's a sizable correction in a bull market stock of about 20%.
Yeah.
Has the stock corrected enough?
God, that is very difficult. But it's just a question of your view of as to how long you want to hold it. So now I can come and tell you, at 315 there was froth in the market, and then now it's come down, now it's good. But if you are taking a 5-year view, it doesn't matter whether you buy a stock 10% higher or 10% lower. I think that's the way to go about it. Most of these companies that we discuss and which I own and which I'm not recommending, we're just discussing here, they are being discussed with a view as to suggesting as to what a stock can do over the next 2, 3, 4, 5, 6, 7 years.
Which is one housing HFC stock you would recommend at these levels?
I normally, I own the 2 which we discussed last time, and I own it and I will keep owning it.
Have you added more?
Yes, obviously, why not?
And why have you added more?
Because the new incremental idea that comes to me doesn't look as good as the one which I already hold. So why not add to the one which you know very well, which you are sure that is going to do well for you, and why look for the new one always? I mean, that's it. But there are companies which come to you all the time, but then you evaluate it on the basis of your domain expertise and your knowledge as to what you are holding, and then you evaluate them on that basis.
At a private forum, you told me you like Whirlpool. Yeah. And again, the basant Maheshwari effect of magic, the stock is at a 52-week high. Now, Whirlpool is a good business, but it's a very volatile and a tough business.
Right.
What is so special about Whirlpool, and why do you like it?
I mean, it's a Canadian management, so obviously I hope they will not lie. And the management has said that they want to grow at 25-30% for the next 2-3 years. So if that happens, and it's again a consumer recovery thing. So if the overall GDP grows and this curve, see, if you're making a smart city and you're making homes there, obviously the homes would need washing machines and air coolers and things like that. So all these companies would do well. It's basically a subset of the broad trade that we are doing. But on valuations, if you just look at Whirlpool, it'll again look expensive. But then you look at the market cap and say, okay, at this kind of a market cap, how is this company going to do over the next 2, 3, 4, 5 years? And they should do very well. And these are companies, see, sometimes you have to buy a company just to play a small trend. So if the trend is about consumerism, if the trend is about the GDP going back, if the trend is about interest rates coming down because EMIs would become affordable, then these companies would all do well, obviously. So that's the broad thing.
You know, Page is a market leader. They're gaining market share on a daily basis. Housing finance companies, they have a moat around them and they have a serious entry barrier. Whirlpool represents a space which is hyper competitive.
Yeah,
you've got the Chinese, you've got the Koreans, you've got the Indians. And does it make sense to buy a Whirlpool when summer this time could be dodgy?
Whirlpool is not a life partner. It's a dating partner. You hold it for 3 years, 2 years, you look at the swing, and then you get rid of it. It's not a stock I can say you can Whirlpool or anything for that matter. You can't hold it for 5 years or 7 years or 10 years. You just play it for a swing, 2, 3, 4 years. When the uptick comes and things are very good. See, these kind of stocks have to be sold when things are looking at the best, and they have to be bought when things are looking at the worst. They're the consumer cyclicals. I wouldn't like to be so rude to these companies, but in some sense they are like the consumer cyclicals where, you know, you buy a Tata Steel when the results are bad and you sell Tata Steel when the results are good. So that is, I think, the way to go.
So what's your price target for Whirlpool, since you're calling Whirlpool as a dating partner?
I mean, if it doesn't double up, I don't know. I mean, it should.
What was your purchase price?
Purchase price is far lower, but we recommended it long time back, 200.
Okay.
And that time the company was in despair, it wasn't turning around and things like that. But from there it's tripled or quadrupled.
I think it's at 900
It's about 800 plus. I think they should do well. You know, I normally don't set targets because you don't know what's going to happen. When I bought
This one is a
Page,
dating partner, so I'm sure the date has a timeline and a lifeline.
when I don't like my partner, I'll say, okay, thank you.
As of now, there's no problem.
No.
Let's talk about the broader market setup. Yeah. You know, for the moment, quality stocks are trading at premium. Some of them are trading at frenzy valuations. Right. Do you think this love affair with quality will continue?
It will continue as long as the overall economy doesn't grow.
Okay.
So once you have, like I told you, once you have an L&T growing at 25% or ACC growing back and cement demand coming back and things like that, then this dilution will happen. Look at what's happening to the pharma companies. Look at what's happening to the agrochem sector. So I think there is a huge buzz around them because growth is scarce. And wherever people find growth, they say, okay, I won't make money for 2 years. Let me make money for the coming years. And obviously you will go wrong because you will tend to overestimate things. And I don't know what stage we are in. That we will know only after you have gone wrong. So my sense is that if you got a winner, see, 70% of investing misery can be cured by not selling a winner too early, and 30% can be cured by not averaging a loser. If you can buy 5 stocks and if one of them does well, the stock which does well will do so well that it's going to compensate you for 4 sins in life again. So I think that's the way to look about it. But just to dismiss it, that it's not going to do well. Like I give you an example, na? Hindustan Unilever with a growth of 12% trades at a P of 40, and it's like, you know, 2 lakh crores market cap. You cannot dispute and say, no, the price is rigged. For a small cap, you can say the price is rigged, but with a lever, you can't dispute. And Asian Paints, look at the growth and look at the market cap. So there's an entire sector which is like that because people are very scared and afraid.
But ultimately, earnings have to converge or prices have to come down. Asian Paints, the volume growth is early teens.
Nothing, right.
The stock is trading at a P multiple of 50 to 55 times. Right. I understand there's a growth scare in the market, and this market is all about backing companies which have great capital allocation. But there would be a turning point. I mean, let's remind our viewers that in the last bull market, it was not about capital allocation. It was about, you know, balance sheet expansion.
The problem with these companies is if you get stuck, the problem would be that the price wouldn't move for 3 years.
Okay. So time-wise correction is
time-wise
something
correction will come because they are free cash flow companies giving you dividends. The price won't collapse by 40%. 20-25% collapse in prices. I mean, anything can collapse by 20-25%. That's not a big deal. But the price won't halve itself. That's my thought. I mean, and that's always debatable. But because the cash flow is positive, but had this been a negative cash flow company, which was diluting equity and raising debt, then higher valuation posts as a major trade. See, most of the times, investors don't lose money because of high valuations. They lose money because of faulty management or because the growth comes down. So instead of looking at these companies as to whether they are very high P and one shouldn't buy them, just take a broad concept. 100 smart cities. Who's got 50% market share in paints in India? Asian Paints.
More than 50 actually.
So if Asian Paints paints up those smart cities 50% each, so you don't know. I'm not saying it's cheap. I'm not saying you're going to make 5x from here
But
in
those
3
100
years.
smart cities would also need steel and cement. So the upcycle in cement and steel will also come then.
No, there is obviously that would also happen. But the point is, till the time that happens, cement and steel stocks are not doing well. What do? Tata Steel, had you bought it for the last 20 years, I doubt even if you've made bank FD returns.
It's been a massive underperformance.
No, not for 1 or 2 years, for 20 years.
That's the nature of commodity business.
That's it. So they are again those what I call dating partners. You buy them, you sell them. And for those kind of companies, you need an entry strategy, correct? And you need an exit strategy.
So what are your existing dating partners then, apart from Whirlpool?
No, I don't. No, not too many. I don't like dating.
So you don't
partners.
even like to date with a sub-quality company?
No, not at all. No position is too big for a stock that is going up, and no position is too small for a stock that is coming down. That is the basic thesis behind which we run concentrated portfolios. And I'll give you an example. Let's say you have 4 stocks, right? There has to be a diversification within that concentration. How? The top 2, if you put say 30% each, and the bottom 2 you put 20% each, then what happens? Even if you make one mistake in life, right? The top 30% blows itself up and goes to 0. And if the other 3 companies grow at 25% for the next 1 year, you recover your original capital back. But if you're running a concentrated portfolio with the number 1 stock at 60% and the other stocks at 10% each or 12% each, then for one wrong decision, if your 60% stock goes wrong, you need 3 right decisions and lots of luck and prayer to God for you to get your capital back. So within the concentrated portfolios, you have to diversify yourself in some sense that one wrong decision can be cured by just one right decision. So that is one way of doing it. And if you're concentrated with sector leaders, with companies and they've done well with me, what happens, Nikunj, is over a period of time, the strategy which works for you, you try and follow it. I mean, if I buy 50 companies tomorrow, I wouldn't be able to sleep at night. But if the guy who's holding 50 companies, you ask him to buy 5 companies, he wouldn't be able to sleep at night. So it's just a question of what has worked for you, and this has worked for me. So that's
a brilliant advice for our viewers, that stick to your core competence.
Yes, obviously. I mean, there is no invitation to follow concentrated portfolio strategies because it's worked for somebody. It might not work for you. I mean, see, borrowed conviction is dangerous. But the question is, if you can borrow conviction and if you're borrowing capital and then you're working it, then you're going to blow yourself up. But if you are convinced of the strategy on your own, then you should. Now, in a concentrated portfolio, if I tell you I'm holding 1 steel company, 1 shipping company, and 1 metal company, and 1 ONGC, then there's a problem. But if in a concentrated portfolio, I'm holding secular growth, free cash flow companies with dividend yield and top class companies in their own fields. Oh, that's
Glad you could join us, and thank you for that disclosure. That's it on this edition of Market Makers. I'm Nikunj Dalmes signing off. Thank you for watching the show.